Welcome to this explainer. Today, we're going to completely shift your accounting mindset. If you're used to the traditional business world, you probably think the ultimate goal of any organization is the bottom line, right? Making a profit. But what happens when an organization's ultimate goal isn't making money, but actually making a difference? Today, we're focusing on purpose. We are going to break down the fascinating financial mechanics of not-for-profit concerns. Here's our roadmap for today. We'll be covering the service motive, profit versus not-for-profit, the receipts and payments account, the income and expenditure account, preparing the balance sheet, and we'll wrap up with some specific financial items. Section 1. The service motive. Let's start with the absolute foundation. Why do these organizations even exist? Okay, let's really dive into this. Unlike a standard trading business, organizations like your local sports club, that charitable hospital down the street, schools, public libraries, they are driven entirely by a service motive. They just aren't formed for profit-making. They don't manufacture goods or trade things just to enrich some owners. Instead, they exist to provide qualitative service to their members or to society at large, and usually at minimum charges. So right out of the gate, their entire financial DNA is fundamentally different from a typical corporate entity. Section 2. Profit versus not-for-profit. Let's contrast this mindset with the profit-driven accounting you might already know. So here is the stark contrast. While a trading business builds its final accounts from a trial balance to calculate its net profit, a not-for-profit doesn't even use a trial balance. Seriously, no trial balance. Because they deal mostly with public money, things like subscriptions and donations, their foundational document is actually something called a receipts and payments account. Section 3, the receipts and payments account. Let's look at this first major tool in their toolkit. I like to think of this account as a giant wide net, catching every single drop of cash that flows into or out of the organization. It's a real account, which means it deals strictly with tangible, real-world cash and bank balances. It starts with your opening cash and ends with your closing cash. Basically, if money physically changed hands, it lives here. The crazy thing about this account, it doesn't discriminate at all. It's essentially just a summarized cash book. It literally doesn't matter if a member is paying last year's overdue subscription, this year's current fee, or prepaying for next year. If the cash moved, boom, it goes on this statement. Also, it doesn't separate everyday revenue, like paying the electric bill, from major capital expenses, like buying a whole new building. All receipts on the debit side, all payments on the credit side. And this is absolutely crucial. Because it only tracks actual cash, it completely ignores non-cash items. Unpaid dues, outstanding expenses, not on here. Section 4. Income and expenditure account. Let's see how we filter that cash down. This is our fine filter. Once we've caught everything in that wide net, the income and expenditure account acts almost exactly like a profit and loss account in a traditional business. It's a nominal account, meaning it tracks expenses and incomes. But unlike that wide net we just talked about, this account strictly filters for only the everyday revenue and everyday expenses specifically for the current year. Now, you might be wondering, and it's a fascinating question, if we aren't trying to make a profit, how do we know if our sports club or library actually had a good year financially? How do we measure success? Well, instead of net profit or net loss, we measure success by looking for a surplus or a deficit. In this account, we debit all current year revenue expenses and credit all current year revenue incomes. And because we want a truly accurate picture of the year's operations, we absolutely do include non-cash items here, things like depreciation of equipment or subscriptions that are outstanding but belong to this year. Basically, if our income exceeds our expenditure, great, we have a surplus. If we spent more than we brought in, we've got a deficit. It's really vital to understand how these two statements interact. The receipts and payments is basically a blunt instrument tracking pure cash flow across all time periods in all categories. The income and expenditure, on the other hand, is a precise, surgical measurement of just the current year's operational health, accounting for what we actually owe and what we're actually owed right now. Section 5. Preparing the balance sheet. Time to look at the organization's long-term health. Just like any standard business, a not-for-profit absolutely needs a balance sheet. Remember, this isn't an account. It's a statement on a specific date that tracks the organization's major assets. We're talking land, buildings, investments, sports equipment, against its liabilities. It shows the real net worth of the concern. But there is one major difference on the liability side. Since a not-for-profit has no owners, there is no owner's capital, no shares, no equity. So instead, they build a capital fund over time.
You calculate this by taking the opening capital fund balance and adding specific capital receipts to it. This could be a portion of entrance fees, legacies left in a will, or special donations meant for long-term growth. Finally, you take that surplus we calculated in the income and expenditure account and add it directly right here to the capital fund. Or if they ran a deficit, it gets deducted.
Section 6, Specific Financial Items. Let's dive into some of the unique funds these organizations handle. Managing a not-for-profit requires really strict classification of incoming funds. Everyday items, like member subscriptions and general unrestricted donations, those are considered revenue receipts. They go straight to our income and expenditure filter to cover daily operations. But what if a donor writes a massive check specifically to build a new library wing? That is a specific donation. It's a capital receipt, and it goes straight to the liability side of the balance sheet, totally bypassing the income statement entirely. Similarly, entrance fees are often treated as capital receipts and added directly to the capital fund to build the organization's future.
This brilliantly illustrates our whole framework in action. Look at how the total receipts and payments flow. Everything starts right in the middle as a receipt or payment. Then it gets filtered. Revenue receipts and payments get routed to the income and expenditure account to determine this year's surplus or deficit. Meanwhile, capital receipts and expenditures, those long-term, non-recurring items, are routed directly to the balance sheet to build up the assets and that capital fund. It's such an elegant system designed to keep public money properly categorized and entirely transparent.
I want to leave you with a thought to really ponder. In the profit-driven world, a massive bottom line is always a huge victory, always. But in a not-for-profit, a huge surplus might actually prompt questions about whether those funds should have been deployed to serve the community better this year. It's a fascinating balancing act between ensuring long-term financial stability and maximizing immediate public impact. Keep that in mind as you review these statements that keep the world's most vital service organizations running. Thanks so much for joining me on this explainer.